All right, I've been really looking forward to get this done. This is one of our larger holdings, and we have been down in the past more than 10%. Not exactly sure where we are now, but maybe hovering around that 10%. Either way, definitely want to do an analysis to determine whether or not we're going to purchase more shares. I do want to say right away that I went back and looked at the analysis I did back in August of 2022. And I predicted most things correctly. One thing that I got completely wrong was the cash balance. And the reason for that is because as interest rates go up, um, persons start taking their money out of the bank and putting them into other investment vehicles that can give them a larger return on their money. This is something that Regions has talked about quite a bit in their earnings calls, and it was always a surprise for Regions that money was not coming out of the bank. But of course, Q4 2022, all of a sudden, all the money comes out of the bank, and so I initially predicted that the cash was going to be somewhere around 40,000. It was 20,000 back in second quarter of 2022. It was 20,000, and so I predicted that it was going to continue to increase. That didn't happen. It dropped off by a lot, as you can see, a 62% drop from 2021 to 2022, and so that made a huge difference in the overall analysis. But even with that, it was not completely off because, as we know, in 2022, the high for the price was $25.57. And so, even though my prediction was somewhere in the neighborhood of 26 to a bit more, I remember saying that I seriously doubt that it was ever going to go to 30 or 31. Um, Either way, that being said, the very first thing that I wanted to um, focus on was that cash balance. Now, because we had such a huge drop over the past year, that really throws off the statistics on this thing, right? Just to go over kind of what you're looking at here, this is the predicted values for the end of 2023. Okay, so this is predicted for Q4 2023. And then what you're seeing here are just statistical possibilities. All right. And so this is using standard deviation. This is using a simple average. All right. Statistically, this simple average gives you something like a 70% confidence in prediction rate. And then standard deviation, same thing, somewhere around 70%. If we wanted to get more accurate than that, we can, but that means that we're going to have even broader ranges of variables. And so, for instance, with a cash balance here of 2,000, if we were to, if we wanted to be, 90% accurate, this number would actually be a negative, and we know that's not going to happen. And so, some of these statistical numbers we completely throw out because we know that it's just not going to happen, even though statistically it can. Okay, at higher confidence intervals. So, first things first, cash ending of 2022. The question is, does cash continue to come out of the bank? Um, you know, Even guys like myself, small time, not managing a lot of cash, even I'm thinking about moving into something like a CD or something because they're paying almost 5% interest on those things, and I can get much more return on my money versus having it in the market or having it sitting in the bank for sure. So, statistically, it can go down to 2,000, which hard to imagine that happening. We see it. It could possibly be flat, and then there's some growth here. I don't think the growth happens. I don't think the growth happens. And so what we're looking at is literally just a range of options here. And so either we're going to choose something within a range, or we're going to go with an actual statistical data point, right? And so what I decided to do was just go with the lower number. It's definitely going to be conservative, no doubt. I mean, I think this is probably a worst case scenario as far as people pulling cash out of the bank. But as you'll see in a moment, I think it works out well with our predictions here. All right, investment portfolio. This is everything from mortgage loans to commercial loans to personal loans. It's everything thrown in there. Okay. Currently, Q4 2022 is sitting at 29,990. All right. And so, again, concerning, where we are at economically, they've definitely diversified their business. And so they've gone into mortgage, they've gone into capital markets and all these things. But I don't see a lot of growth happening over the next year. But I don't think it falls off a cliff either, right? And so again, we're looking at some statistical ranges here. It goes from 29 all the way up to a growth of 356, but again, not a huge jump. Okay. And so what I did was I kind of kept it flat just at this 29 440, which is really a drop, which is on average, this thing has been dropping over the last 3 years. So I think that was a decent number there. All right, loans. This one was really interesting. I kept going back and forth because literally the entire analysis, price point analysis, hinges on where the loans go. And so, I went back and forth with this, I did eventually, I eventually had to make a decision, right? And so, I found this from their previous earnings call, and they're expecting loan balances to grow at 4% year over year. That's what the company is saying. That's what management is saying. They think they're going to actually grow their loan portfolio. Now, either they're going to grow their loan portfolio or it's going to remain flat. Can they sell some loans? They can. If they sell loans, then that means that the cash is going to get larger, and so I think that really balances the asset side of the balance sheet, and I don't think we need to worry about it that much as far as selling loans. The question is, do they grow loans, right? And like I said before, this is a huge drop. Just look what happens if I go with the smaller, right? Let's say loans really fall off a cliff, right? They maybe the loans go bad, people aren't paying them, and they just have to write them off. That happens. That makes the total assets 131. Okay, and currently asset balance is 149. We've never seen a drop like that over the last 3 years, right? We've seen small drops there, small raises there, but that's a huge drop from 150 all the way to 130. So I don't think that happens, And so what I did was I just went with conservative growth, right? We can also keep it flat, right? Just assume that nothing much is going to change at all. And as you can see, it's still a huge drop off. So everything is hinging on this loan growth right now. All right, let's go through the rest of the stuff. Other assets, these are basically derivatives and other investments that they use to manage their cash, manage their risk, manage their interest rates, and things of that nature. As they buy more of these derivatives, this balance goes up. Okay. The same thing happens on the liability side as well, because sometimes these things are done on credit. And so these investments may lose some money. And so that'll be a liability as well. They did talk about in their earnings calls last year about purchasing these derivatives in order to manage the interest rate risk. So right now, they know the interest rates are going up. Therefore, they are buying investments in securities that will appreciate when interest rates go up. I can't remember the exact number, but I think they said that they were positioned for interest rates to be somewhere around 5%. If it goes higher than that, then that can be a problem, right? And so, again, right now that balance is 10,337. Again, and I want to say this too. It's one of the largest variables on the asset side that moves around a lot. So looking back at the last 3 years, you see, drop by 1% and then way up 25%. And this 25% bump is just the activity that management was doing to, like I said, to get in front of these interest rate hikes. And so again, the question is, do they start now reducing that balance? Okay. If they think interest rates are starting to go down, do they continue to add to that balance, or does it stay where it is? And of course, we're trying to predict this thing out over the course of a year. A lot can happen in between then, but we have to make a decision on this stuff, right? And so my thinking is that it's definitely not going to hard to say. It's hard to say. Again, I don't think this is going to be a big difference, though, in the analysis. Let's play around with it a little bit. This is a small drop. Let's go ahead and keep it flat for now. Let's see what happens. Property, not going anywhere. I think all banks since COVID have been closing banking centers. I think that's going to continue. Just a small continuous drop year over year. And so 718 right now, and I think that can definitely get down to 1635. I definitely don't see them adding to their real estate holdings. I don't see a reason to. All right, interest. Again, this is one that is hugely variable, and these are loans that accrue interest that are being paid to regions. Right now, a lot of this gain is because they did purchase those companies last year that added a lot of interest to the books. Like I said, mortgage, they were doing home remodeling loans, commercial loans, all these things. And so I don't think they're going to, in this environment, right? I mean, interest rates are high. I don't think people are buying loans and applying for loans as much as they were in the last year or so. And so my thinking is this number is going to either remain flat. Hard to say whether or not it's going to come way down, but I'm thinking it's either going to be flat or we're going to see a small bump. Right now, let's leave it flat and see what happens here. All right. Deposits. Again, this is money that's being deposited into the bank. And for a bank, that means it's a liability because the bank has to, if people want their cash, the bank has to provide them cash. And so that's a liability. Now, we know that money is coming out of the bank, right? And so we definitely want to decrease this number from the 131. The question is, how far do we decrease it, right? Do we assume that it's going to come way down, right, to this 2,000? If so, then we have to go with the lower number here, the 123. And that's what I've been doing, right? So if I'm playing around with the cash up here, then I have to increase or decrease the deposits down here. All right, debt. This was another one that, I didn't even go into researching this because it's sort of weird, right? So you see this big number here, 19%. They've been reducing their debt over time. They did, like I say, purchase some companies. Usually when you purchase a company, you're also purchasing your debt, and so that increases your debt. But for regions, that has not been the case. And so the question is are they going to continue to decrease their debt, or are they going to, increase it or leave it flat? I have to imagine that right now with higher interest rates, it doesn't make sense to go out and get new debt. So I definitely don't see it increasing, right? So we can throw these two options out the window. So now we're just looking at this 15 or this 18, right? And then the question is, well, how much do they decrease their debt by? And being that obviously they've done, over the last 3 years anyway, done pretty well decreasing their debt. Again, I'm going to be conservative about this. I'm going to be conservative and say they decrease it, but not all the way down to 15. So I'm going to leave it at 18. All right, and then other liabilities. Again, this is directly related to all the derivatives, the investments, the securities that they invest in to manage risk and manage cash and those things. This number has bounced around quite a bit recently, as you can see, up 67%. And so that's another thing to keep in mind is as the assets appear for the derivatives and everything increase, the liabilities look like they increase even more, right? And so again, the question is, do they, remain flat? Does it grow? Does it decrease? So we have to kind of keep these things aligned. So here we said they were flat, so that means we have to keep it flat here. All right, now what that does is it gives us a net balance of 15,000. The other thing here is, again, these are statistical data points, okay? This is assuming that everything here happens. This is assuming that everything here happens. So again, as you see, a range. So, the balance sheet, net, this is the actual worth of the company if they were to sell everything. I think I also need to mention here, I've said it in many videos before, but I'm not including goodwill. I'm not including any intangibles. The reason why is because it's really hard to value intangibles, and goodwill is not a real thing, right? It's the money that you pay for a company over what it's actually worth, right? So if the company is worth $1 million and you pay 1.5 million, then 0.5 of that is listed as goodwill. If they were to sell these companies, are they going to be able to sell these companies for more than what they're worth? Maybe, maybe not. Again, these are conservative estimates, and so I'm not including the goodwill or the intangibles, things like proprietary software or even the name Regions Financial is not included on these assets. So, like I said, right now the book value is 9969, and it's hard to see a big increase, especially because it's been coming down over the last 3 years. And so when you see a net balance of 15 and it was 9, we know right away that something ain't right. We either need to increase our liabilities or we need to decrease our assets, right? So the question then becomes, which asset do we decrease? And so we already talked about interest being very variable. And so now it's very easy to come in here and choose that lower number, right? But that still doesn't get us where we need to be. The other thing are these other assets, these derivatives and securities and whatnot. If we see interest rates start to come down, I have to assume that they're going to have to unwind these derivatives and these securities, right? And so that means that we're going to see a drop. Right now, let's just assume a small drop, not anything big. We can't really touch property. We already talked about loans. The investment portfolio, I don't think they're going to buy any more companies. And again, being that the economy is where it is with interest rates and everything, the idea that they're going to bring in just like way more clients, hard to see right now. So anyway, so I think that's all we can really do on assets. On the liability side, we have to get these things increased, right? And so the only thing that I see right away that I can really make any changes to is these other these other liabilities that again are related to the other assets. Now, if the assets come down, then the liabilities have to come down further. That's what we have seen, right? So what we'll do then is we will choose the smaller option, and that still gets us to a net 15,802. The only other thing that we can do is leave debt flat. And we can drop the deposits, but not super high. How about that? And that gets us to 12. We still have some work to do. And again, like I said before, everything hinges on this loan number. It really does. And as much as I want to, use these statistical numbers, they're just not working with me. Now the best part about all this is I had it worked out before I started the video. Then I started playing around with stuff. That's what makes it fun, you know. So the interest, the loans, investments, cash. I want to bring down the assets, but I'm just not seeing a way to do that. And, you know, the assets at 144 versus 149 is a slight drop, but not a crazy drop. So I'm really okay with that. It's the liabilities that I think really need to come up. And the only way to do that is to increase the other liabilities. And the way this happens is if the derivatives and the security products that they're using to hedge interest rates and everything, if they start going south, if they're not working, right? If they're not working, then that will cause that. But if we do that, then I want to raise the assets to maybe even. So I'm imagining, all right, you're hedging interest rates, right? Okay. You're hedged to, let's just say 5%. Okay. Now what's happening is maybe interest rates continue to go up. And so you're either going to have to get rid of some of the derivatives, you're going to sell them at a loss, or you're going to add more, which then also increases your liability. The other option I'm thinking of is if interest rates start to come down, right, and you're still in these securities and derivatives, well, now you start to unwind. So you start to lose some of these other assets, but then the liability side also comes down. So again, the only way for this to work is the liability of those derivatives and securities has to increase, meaning that they have to go bad. It's the only way I see that working. Otherwise, we're going to have a growing balance sheet, which is not, not impossible, but in keeping with what has been happening the last 3 years, I don't see that happening right away. So, increase in liability, right? And then a decrease in the assets. I can be okay with that. All right, that gives us a net of 9,633, which puts us just a little under where it is now. Again, a declining net balance sheet, which has been the case. So now we go to price. Now, I want to say this, the price to book ratio is how how much more is the stock price worth versus what the book value of the company is. Okay. These are historical numbers based on the high and based on the low for the year. So in 2022, the highest price that Regions achieved was 25.57. And based on the actual number from the company, right? Or here rather, yeah. That gives us a price to book of 2.5. Now, keep in mind that this is not going to be the price to book that you're going to see on, on the internet, because I'm not including goodwill or intangibles. So it's going to be completely different, but same numbers, just without the goodwill in there. Okay. So, 2.5, and then 2021, 199, and 2020, 135. And what I noticed about this, what I thought was interesting, is that it's been increasing. Every year. And so what that means is that persons are willing to pay more for this stock year over year. I mean, that's just what it is. Same thing happens with the lows, right? So at the lowest point in 2020, which was a COVID low, $7 a share, right? Which gave us a price to book at 0.54. Now, I want to say this to make sure we understand what's going on. Banks typically trade at 1 times book value. The reason why is because most of what a bank owns is cash. So there's no reason for a bank to ever trade at less than 1, right? It's a very common thing that if a bank trades below a price to book value of 1, you buy that bank immediately, right? And so with the gift of hindsight, we know for a fact that when this thing hit 0.54, that was the time to buy with everything you own, right? Because you would have bought Regions at $7 and see the price shoot up to what, 24.89 a year later. That's like 400% return, right? But either way, the point is here is that even at the lows, it's increased year over year for the last 3 years. And so because of that, what I decided to do then was to look at what that increase was. Okay, and that's what these percentages are down here. And then based on that increase, they gave us some statistics. All right. So on average, again, 70%, confidence interval. The next high, okay, ought to be 3.4, all right, or 3.08. If everything continues the way it has gone. Same thing with the low. It ought to be 3.28 or 1.15, which is a huge difference, right? But anyway, right now, predicted value, price to book, 2.33 at the current stock price of $23.35. Now, if you look at this 2.33 and look at it historically, right? It falls in line right around, last year, 2022. It puts the stock price at fairly valued at this 23.35 price. And I'm going to say slightly undervalued, right? Because again, 2.5 was the high, right? And we know historically that number has grown. So even if the number does not grow, right? Even if the number stays the same, it's the stock price is still undervalued at 23.35. All right. Now let's play around with the price a little bit. Let's go up to $24. That gives us a price to book at 2.4. Again, fairly valued, slightly undervalued based on historical price to book data. All right, let's look at now $25 a share. That puts us right at the 2022 high of 2.5. So I can confidently say that $25 as a high for 2023, I think is a good bet. However, again, statistically, last 3 years, that number has continued to grow. And so if we look at 26, That puts us at 2.6, 27, 2.7, 28, 2.8. Let's go up to 30. All right. So at $30, and I think this is interesting because the last analysis I did in August of 2022 gave me the same numbers of roughly $30. Again, statistically, you know, it's possible, right? I don't think it's going to go there. I really don't think it's going to go there, but statistically, it is possible. You know, I think this number we can throw away, right? This 3.28 as an absolute low. That's just not, that doesn't even make sense, right? And then I think this high of 3.41, I think even that is a bit ridiculous. And so I'm happy using the statistics here with the standard deviation to give me 30. And then now let's look at the absolute low. All right, so we'd have to get all the way down to $12 a share to get anywhere near the low. Now, wait a minute. I'm seeing a problem here. Oh, okay, no. I know what's going on. I get it. Okay. Yeah. Again, because this thing has grown. Yeah, there we go. There we go. Okay. So, again, throw this one out, 0.25. You know, historically, we're not going to get worse than COVID, right? Um, and the 238, again, I don't see that happening. That would give us an absolute low of 23. And I think already in 2022, or 2023 rather, I think we've already hit the $23 range. So the question is, you know, is 23 the absolute low for 2023? I doubt it. I doubt it. Which is why I'm feel way more comfortable looking back at the 2022 price to book ratio. Another thing want to look at talking about price to book. I went and grabbed the price to book history for regions. I can blow this up a little bit. Okay. And as you can see, the price to book has basically been on an upswing since 2010, right? And that is right in line with what we're seeing statistically, right? There are some drops, of course, right? But overall, this thing has continued to rise. And when we do see a drop, it is literally like 1 year. So we got 2018, a drop in 2019. Um, there's a drop 2011, 2013. Not sure what that's about. 2018, I know for sure we had a definite issue in the market. And then 2019, 2020, that's the COVID low. Is what that is. So again, you know, I think that this number is either going to stay right at that 2.5 or it's going to increase some. Now, I did pull up to their competitors. This is Truist. Their price to book has really kind of been all over the place. but sort of flat-ish, right? Um, the other thing I think is important is looking at the price to book for Truist, 1.14, and then for Regions right now, this is 1.53. All right. Next one, KeyCorp. And again, these are all of their competitors, right? So again, price to book continue to increase. Persons are willing to pay more for the company over time. Price to book 1.5. First Republic Bank. This one is pretty horrible, actually. I mean, it's exactly where it was 10 years ago. Obviously, they've had some real issues. Not quite sure what's going on there, but price to book 1.6. All right. Now, the higher the price to book, okay, the more expensive the stock is, and you can say that the less opportunity the stock has to actually improve as far as the price goes, right? Look at U.S. Bank Corp. Again, really a wild ride, very flat. It hasn't gone really up or down. Weird situation. 1.6, and that's it. Okay, yeah. So, 1.5 for Regions is definitely um, not much different than the rest of their peers, right? But it's on the lower end. The only one that's lower is Truist, which means that this stock is currently cheaper, meaning that it has more opportunity to the upside. There's more risk to um, than loss. Like you can make more than lose, right? But again, like I said, kind of looking at the chart, I think Regions just looks better historically, you know. So again, with all that said, you know, I think 2.5 is definitely a conservative estimate. 2.6 is not out of the realm of possibility at all, and statistically, we know that it can get up to this 3. So based on the balance sheet, I'm going to call a. It's 176. Let's see if I can get down to 176. There we go. So I'm going to say the absolute low for Regions Financial in 2023, $18. Absolute high, I'll put it at 26. And again, that's going to be a conservative estimate. Okay, so what did I say? 18 to 26. Now, looking at the dividend, I didn't do a bankruptcy analysis on this company because there's just no need. But I did want to look at the safety of the dividend, and yeah, as soon as I looked at the numbers, I was like, this was pointless because right here, this is I'm trying to remember how I did this. Number of shares times divided by. Okay, so this is the percentage of net income that is used um, to pay the dividend. All right. So in 2020, 57% of net income went towards dividend payments. And I want to make sure we understand net income for a corporation is just money left over, right? And so after the company pays out its dividend, whatever money is left over still has to go somewhere. So either they're going to use the leftover money to buy other companies to hopefully improve the performance of the company. They're going to do stock buybacks. They're going to raise salaries. Something has to happen with that, with the rest of that money, right? And so being that currently only 30% of net income is used to pay a dividend, they can and they will continue to increase that dividend, okay? Which they have done, as you can see. So in 2020, the dividend was 62 cents. 2021, dividend was 65 cents. In 2022, it was 74 cents. And currently, the dividend is 80 cents. Another thing I think is really cool here is statistically, when we use the average and the standard deviation, we get these statistical data points for where the dividend can be in 2023. Okay, and like I said, we know right now for a fact the dividend is paying 80 cents a share, right? And statistically, we got that exact number, right? So just again, just another illustration of how statistics work, and just proving again that it works. So anyway, so yeah, so another thing too, the shares have continually dropped because, like I said, they have to do something with that net income, so they've been buying back shares. So as you can see, shares went from 1,000 to 983 to 976, and so we're expecting that to continue to drop. 963 is kind of the prediction. So 963 shares at 80 cents a share gives us 34% dividend coverage with net income. All right. I've said it before. I'll say it again. Banks don't typically trade on net income, but I do think it is interesting to look at, because what this can do for us is really verify that our predictions and numbers for the price based on the balance sheet actually work. Okay, so first things first, the income total from the bank is very simple. I've included everything in this one number. Okay, as we can see, it has stayed pretty stable. There was a jump over the last year because of those additions that they made to the company. And so the question is whether or not they're going to continue to grow income, or are they going to, come down a little bit. Now, Regions themselves say that their revenue, they think, is going to climb 8 to 10%. Okay. And so I think this 7% that we statistically came up with is right in line with where the management of the company sees the income going. So I'm happy with using that statistical number of 80-31. We do have a statistical possibility of 80-52, but that ain't a big difference, right? So I'm going to go with the lower number because I like to be conservative in my estimates. All right. Interest cost. Now, I'm expecting interest rates to continue to rise, and therefore I'm assuming that their cost on interest will continue to rise. However, that may not be the case, especially if they have already planned and agreed to a certain interest rate on their debt. That interest rate may not move much at all. But again, just because of the environment, and also because it is a fairly large variable here, not the largest, but 17% is nothing to shake your head at. I'm going to go ahead and go with the larger number, right? So, and again, that's going to give us a conservative estimate because we're saying they're going to spend more, right? The provision is always a topic of conversation. The reason being is because whenever banks provision money, they're doing it because they think they're going to, they think people aren't going to pay their loans, right? And so it's something that they're always looking at. And honestly, I'm curious as to what the other banks are doing. I didn't pull that information because I don't think it's going to be such a huge difference in our analysis. But I think it's an interesting topic, right? The other thing I spoke about this before is statistically, because this number has jumped around so much, as you can see, 1,300 in 2020, because again, the COVID low, right? I mean, everyone was really worried and scared, and so the bank provisioned more money to take care of any loan losses that they may have. And then the next year in 2021, all of a sudden, they were like, whoa, we don't need all these provisions. And so they actually had provision income, means that they had a benefit, a gain of provision. That's why you see a negative number there. In 2022, they've increased their provisions again, right? And so now we're sitting at 271. And so the question is, again, where are we going to go? So statistically, here are our options, right? So we can see another benefit from the provisions, which is definitely possible. If we decide at some point that, hey, I think everything is okay. We're not going to have any real economic problems, especially in southeast of the United States, Florida, Texas, Tennessee, Carolinas, those areas that typically economically do better than the rest of the country, even in downtimes. We can actually see a benefit from provisions. Or we see that they raise provisions because maybe, like I said, over the course of the next year, we start to get pessimistic about where the economy is going and where jobs are going. So I went with the smaller of the two for raising provisions. Okay, we can play around with maybe lowering provisions to see if it makes a big difference, but I don't know that it will. Okay, next, salaries. Now, the Regions has talked about this quite a bit. Typically, as their capital markets, as their loans, and as their, oh yeah, that's it. Just loans and capital markets improves, the sales improve, then they pay more commissions. Okay, and so we've already talked about where they expect revenue to go, and so the question then is, you know, do they raise salaries much more? We know that other financial institutions have been laying persons off, especially in the investment side of things and wealth management. Regions has not reported any layoffs as of yet, but that doesn't mean that they aren't laying off, right? It just means that maybe they aren't doing like mass layoffs. And so, I think we're either going to keep the salaries flat or we're going to increase them a little bit if they happen to just, for whatever reason, do a bang up job about bringing in more sales. I don't think, I mean, hard to imagine. Again, we're talking about a year from now. So who knows? Maybe fourth quarter 2023, we're feeling a lot better about the economy. Interest rates are coming down, and then people are rushing to get loans. Very possible. Very possible. So either way, going to increase that just a little bit. All right, taxes. This is, again, one of the largest variables on this income statement. And I really don't, because they brought on so many additions to the company that are not traditional, like, banking things, right? The tax rate went up quite a bit from where it was in 2020. And so, I think that stays the same. The only way that I see taxes increasing more is if they continue to bring in other types of businesses, which they have not discussed. Doesn't mean that they won't at some point in the future, but as of right now, they have not discussed bringing in more acquisitions. And so I'm keeping the tax where it is. All right. What does that mean for the net income? It means that we have a small drop. Now, over the last 3 years, outside of 2020, the income has been fairly stable, but it has dropped some, right? And so I'm okay with that. I don't think that's going to be, that's going to be that big of a deal. Maybe it improves a little bit, especially if we play around with provisions. Let's go with the conservative 100 there. There we go. Now all of a sudden we see an improving net income. Go back to that. Okay. This is what I wanted to get to. All right. Historically, price to earnings ratio. Well, let me talk about earnings per share first. So this number here, these three numbers are earnings per share. And all it is it's just net income divided by the number of shares. And so that means that if the company makes $1.09 per share in additional income, the stock price ought to move by $1.09 at least, right? At least. Now, the other thing is that we know that just like goodwill, like I expressed, persons are usually willing to pay more than what something is worth. I mean, no different than if I make a ball and it cost me $1 to make that ball, typically I'm going to sell that ball for more than $1. And most people don't have a problem with that because they understand that I took the time, effort, and energy to make the ball. And so you have to pay more than what the ball is actually worth um, in a free market, right? Society. So we know that the earnings per share in 2022 were $2.30. And we know that you're going to pay more than that $2.30 a share for the company, and that's called the PE, or the price multiplier, right? So again, this is based on, the green is the highest price for 2022 and red is the lowest price for 2022. So at the highest price of 2022, the PE that I have here is 11. Okay. And again, this does not include any sort of goodwill or any sort of amortization, depreciation, anything like that. So it's going to be different than what you see on the internet. So 11 is the highest. 7 or 8 is the lowest. Historically, though, it's kind of jumped around quite a bit. I think this 6 or 7 for the low is typical, but the high at 15, 9, and 11, I really don't know what to make of that. And so statistically, you see this wide range of options here. But again, most importantly, right now is we have a PE of, no, I don't have it. So I would have to do the math on that. Let's see. See, price right now is 23.50 roughly. Okay. So it gives us a PE right now today of roughly $10. Actually, I think like 35 cents. Yeah. Yeah. So PE of 10. Okay. The reason why that's important is because the high from last year was 11. So we're very close to that high. Okay. Now, based on our prediction here, we're saying net income is going to be roughly 2,000, which is a drop from last year. That puts our earnings per share at 210 if we have the shares at 963 as predicted. Okay. Now, at the current price that we have here of 18, which is the absolute low, okay, that gives us a PE of 8, which again, I am more than happy with because, again, historically, the low has been around the 7, 6, call it 8 range, okay? This is a bit higher, right, than the 8 down here. And we play around with the provisions, which I think is probably going to be the largest thing, then you see all of a sudden the low drops down to that historical 6 number, okay? And so again, that's kind of the benefit of playing with these numbers, is you get to see relative to what it has been, what it can be, right? All right, let's look at our high. So again, 18 is our low, okay? We're okay with that. And then I said 26 was our high. And so that gives us a PE of 9. Again, if we come in here and play around with the provisions, that gives us a PE of 12, which is much higher than what it has been, but within the realm of possibility, because historically, it's been as high as 15 before, right? So again, not a crazy number. Also, too, looking at the statistical data points, right? Again, based on, what the difference between PEs have been year over year, it can get up to as high as 14, or as 9, right? I'm, again, a lot more comfortable closer to that 11 range. To get there, we'd have to have a stock price of 25 if our net income stays the same. Again, if we play around with provisions, that gets us to that 9, right? So I'm really happy with that. I think 26 is really reaching for the ceiling there, but not out of the realm of possibility. 25 is something I'm much more comfortable with, and that is assuming zero growth in the price to book and zero growth on the PE. And again, going back to the growth of the price to book, you mean, it's definitely been flat before, for sure. But for the most part, this thing continues to grow. So, all that being said, my prediction for Regions Financial in 2023 is anywhere from $18 to $26. I'm going to say at 26 is the absolute sell point. 18 is an absolute buy point.